chapter 1, and then after discussing chapter 1, I will be discussing some of the assigned problems in chapter 1. Then I will begin with chapter 2. We have to remember that our chapters 1, 2, 3, 4, 5, and 17 as in relation to course outcomes 1, 6, and 9 should be finished up to week 2, and that will end on July 2. So barely we have only how many days to take up. Okay? So we have now financial statements. Financial statements are the means by which the information accumulated and processed in financial accounting is periodically communicated to the users. Financial statements are a structured financial representation of the financial position and performance of an entity. So we have now the general purpose financial statements are those statements intended to meet the needs of users who are not in a position to require an entity to prepare reports tailored to their particular information needs. Okay? Reports prepared at the request of an entity's management or bankers are not general purpose financial statements because they are prepared specifically to meet the needs of management or bankers. So we may have reports that are prepared for the use of management. So these are not considered to be general purpose, but they are for internal use or for the use of management. So take note that when we talk about general purpose statements, we have the statements that will be used by all users. So generally, internal and external users. However, internal users will have their additional reports. Okay, so we have now the complete set of financial statements, including statement of financial position, income statement, statement of comprehensive income, statement of changes in equity, statement of cash flows, and the last one is notes comprising a summary of significant accounting policies and other explanatory information. Now you will notice that some of these statements were already discussed in Accounting 1101, including the statement of financial position, income statement, or possibly the statement of comprehensive income and the changes in equity or your owner's equity. So these are not new statements to you. Okay, so we have the components. The objective of general purpose financial statements is to provide information about the financial position, financial performance, and cash flows of an entity useful to a wide range of users in making economic decisions. And financial statements also show the results of the stewardship of management of the resources entrusted to it. To meet this objective, financial statements provide information about the assets, liabilities, equity, income, and expenses, including gains and losses, and contributions by and distributions to owners in their capacity as owners. And we have the cash flows. Okay, now financial reporting is the provision of financial information about an entity to external users useful to them in making economic decisions and for assessing the effectiveness of the entity's management. The principal way of providing financial information to external users is through the annual financial statements. However, financial reporting encompasses only uh, not only financial statement but also other means of communicating information that relates directly or indirectly to the financial accounting process. Financial reports, no? We have now your financial reports that are intended for the purpose of uh, here include non-financial information such as description of major products and a listing of corporate officers and directors. Now we have the objective of financial reporting. Under the conceptual framework for financial reporting, the objective financial reporting is to provide financial information about the reporting entity that's useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. So, in other words, when we talk about the providers of funds to the entity, we are now referring to investors and to creditors. Now, these are the two parties which are considered to be the primary users of the financial statements. Simply stated, the overall objective of financial reporting is to provide information that's useful for decision making. General purpose financial reporting is directed primarily to the existing and potential investors, lenders, and other creditors which compose the primary user group, or we have the providers of funds. The reason is that existing and potential investors, lenders, and other creditors have the critical and immediate need for information in financial reports. So, for information in financial reports. As a matter of fact, the primary users of financial information are the parties that provide resources to the entity. So, in other words, they are providing funds to the entity. Moreover, information that meets the needs of the specified primary users is likely to meet the needs of other users, such as employees, customers, governments, and their agencies. So, in other words, we have the users, including employees. So, actually, we have our primary and then the secondary users. The management reporting entity is also interested in financial information about the entity. However, management need not rely on general purpose financial reports because it's able to obtain or access additional financial information internally. So that is from management. Now, the limitations of financial reporting. General purpose financial reports do not and cannot provide all the information that existing and potential investors, lenders, and other creditors need. They are not designed to show the value of a reporting entity, but these reports provide information to help the primary users estimate the value of the entity and are intended to provide common information to users and cannot accommodate every specific request for information. To a large extent, financial reports are based on estimates. So they are based on estimates and judgment rather than exact depiction. For example, in your statement of financial position, you have the account allowance for doubtful accounts. Kag ang iyas na nga pares accounts receivable. Kag may bad debts. Now, take note that the allowance for doubtful accounts, its balance is only an estimated amount. So you have to take note that it's only based on estimates, no? It's only based on estimates because it's not really let's say exact, no? Ay ti pareho man na ang imo nga accumulated depreciation. When you compute depreciation based on the estimated life of property or an equipment, and actually you are going to use estimated life. That is if you are using the straight line method. Okay, so if you are using the straight line method, so we can now say that the management of an entity is the primary responsibility for the preparation and presentation of financial statements. The board is in the discharging. Now we are referring now to the board of trustees in discharging its responsibilities, reviews, and authorizes the financial statements for issue before these are submitted to the shareholders of the entity. Management is accountable for the safekeeping of the resources and their proper, efficient, and profitable use. Shareholders are interested in information that helps them assess how effectively the management was able to, okay, here, how effectively management has fulfilled this role, as this is relevant to the decision concerning their investment and the reappointment or replacement of management. Next, we go to the general features of financial statements. We have now number one, fair presentation and compliance. So, fair presentation and compliance with PFRS. So, fair presentation and compliance with PFRS. It means that the financial statement shall present fairly the financial position, financial performance, and cash flow of an entity. Fair presentation is achieved if the financial statements are prepared in accordance with the Philippine financial reporting standards which represent the gap in the Philippines. Okay? So that means an entity whose financial statements comply with PFRS shall make an explicit and unreserved statement of such compliance in the notes. Fair presentation is the faithful representation of the effects of transactions and other events in accordance with the definitions and recognition criteria for assets, liabilities, income, and expenses laid down in the conceptual framework. Okay, now second one is going concern. Now may I request you to read the book for the description, for the discussions with regards to the general features. The number two is going concern. Now it means that in going concern, we assume that the entity is viewed as continuing in operation indefinitely in the absence of evidence to the contrary. So, in other words, in going concern, we mean continuity assumption. And financial statements are prepared normally on the assumption that the entity shall continue in operations in the foreseeable future. Assets are normally recorded at original cost. As a rule, market values are ignored. Okay, however, some standards may require some measurement should be at fair value. Okay, so that's what we mean by going concern. You are not at all to mention about liquidation value, but you assume that the business is continuously in operations. Then number three is accrual basis. In accrual accounting, it means that income should be recorded when earned and not when received. So that is with regards to income. And your expenses are to be recorded when uh, incurred. So the word is for income is earned. For expenses, you record expenses when incurred and not when paid. So what's important is when did you incur? It's not when did you pay, but when did you incur. So we have the